A warm welcome to our guests tuning in for this live. We're live from our moomoo Singapore office. I'm your host, Olivia Higgins. And while we wait for a few more people to join us, here's a video crafted and created just for you. Enjoy. Welcome back, everyone, especially those who just tune into the live. Once again, you're here with me from our moomoo Singapore office. I am Olivia Higgins. Now, I'd like to remind you at this point, it's really about education today. So really learn as much as you can from the topic of today and from our guest speakers. Now, today is really about guiding you towards investing smarter. Okay, so it's time to network with the community and make sure that you ask your questions. As always, I'm always going to pick out the best questions to ask our experts. But today we will have some surprise quizzes and giveaways for all of you. So really stay tuned till the end of the live webinar because I'll be dropping it in between. So make sure that you pay attention and take your notes. Okay, so be ready for that and let's hop right in. Today's topic, unpacking ETFs. Today with me from SGX Group, we have Kang Chin, who is the Associate Director of Securities Trading Equities Securities of the SGX Group. From UOB Asset Management, we have Edward Pai, Vice President, Intermediary Sales, and Joelle Lim, AVP, Product Development and Solutions, joining us today. Welcome to the show, gentlemen.
Hi, Olivia.
Hi,
Good to see
Olivia.
you.
Welcome back, Edward, and to Wei Chin and Joelle. It's your first time joining us. Let us really go into the topic, but also first, could you just introduce yourself to our audience members? Edward.
Hi, everyone. Edward here from UOB Asset Management. I'm from the Intermediary Sales team. I think I've been on the moomoo show for a couple of times, so
Yes.
I think quite seasoned. So it's always good to be back here. Yep.
Familiar face. Now, Wei Chin, what about yourself? You're representing the SGX Group. Now, the topic of unpacking ETFs. Perhaps you could tell us a little bit about yourself, but also why today's topic is so important.
Yep, thanks, Olivia. So this is Wei Chin. I'm from SGX Group, ETF Product Manager. So during my course of work, I work with partners like UOBAM, ETF issuers to help develop the ETF market, bring more products to the exchange, and also to increase the awareness of ETF investing among investors, like the ones attending today's webinar. And I guess what's important is in today's webinar is that we really want to bring to the audience a few key highlights in the ETF market, especially why it's a asset class or rather investment tool that has been gaining popularity over the years. And I think today, along with Edward and Joelle, we hope to bring to an audience a more deeper perspective, insights into some of the ETFs that are available, easily available on SGX.
Excellent. Thank you for that. Now, Joelle, let's end with you on your introduction.
Hello, I'm Joel. So I'm from the product team from UOB Asset Management. So I work very closely with the sales team to develop and launch funds and ETF for our Singapore market.
Very important right
Yes.
there. Now, Edward and Joel will be back with you shortly because I'll have a quick fireside chat with Wei Chin right here. So, Wei Chin, let's really hop straight into it. How do ETFs play a pivotal role in the Singapore market, and how is it attractive amongst the investors that are based here?
Yeah. Thanks, Olivia. So ETFs, also known as the exchange traded funds, has increasingly been used by investors, both locally and foreign, individuals and institutions, as an efficient investment tool to allocate their capital into investment. This can be reasons, there can be reasons of building long-term capital growth, looking for passive regular income, and for more active investors who are looking to short-term trading, ETFs also offer them intraday liquidity and opportunities to react quickly to market news and take actions accordingly. So SGX is a home to 41 ETFs that offer investors both locally and foreign markets multi-asset classes into multiple figure region. And among the 41, 27 of them offer direct exposure into equities market, and that goes as far as the US underlying, as S&P 500 indices, Dow Jones Industrial Average, and all the way back home, we do have STI, Straits Times Index tracking ETFs that allow local broad-based investments for retail investors and institutional investors. Beyond equities, we also have fixed income ETFs that offers investors Asia fixed income, China onshore bonds, as well as Singapore SGD bonds exposure. So that allows investors to ride on the fixed income market landscape changes to allocate their capital into products that are not easily accessible to them in the past. Last but not least, we do have a wide range of REIT-focused ETFs to offer investors exposure into both local and regional REIT market.
Okay, well, since you brought up the REIT market, what is the performance so far for the sectors, especially in Singapore, and its positioning on a macro level globally?
Yep. So I guess those who have been following our REIT market, or rather global REIT market closely, there has certainly been a year-to-date drawdown in in fact, most of the REIT ETFs globally. Large of that is mainly due to the rising of long-term interest rates that happened a few weeks ago. I think that has really resulted in a continuous sell-off in the REIT sector. But however, if you look across the REIT ETF interest on SGX, that has in fact resulted in a stronger and higher trading activities for the REIT ETF listed on SGX. In fact, if you look at Q3, what happened was that trading interest in REIT and fixed income ETF has jumped, with turnover increased by 82% for REIT ETFs and also 14% for fixed income. That coincide with the rising rates environment and also rising inflation environment globally.
Now, for the Q3 reports, I know that was just recently concluded, and we are definitely wanting to know what the summary of that was. Now, could you just summarize for our audience members the latest findings as we round off the year 2023 and go into the new year very, very soon?
Yep, sure. So maybe I can start off a bit on where is the AUM and the fund flows are for the local markets. So in Q3, we have seen a stronger inflows for Asian equities, and that's really on the back of the two new ETF launches. One that offers investors climate related exposure into Asia ex Japan markets that brought in a net inflows of over $500 million Sing dollars. And we also welcome a launch of a Vietnam underlying ETF that tracks the IX Vietnam 30 index that's resulted in the total net inflows of over 600 million. Besides that, in terms of net fund flows, we do have ETFs as well that recorded its 8th consecutive month of net inflows in September. So year to date, net inflows for REITs ETF stands at about 71 million. Last but not least, in the fixed income space, we do see the SGD bond ETFs, which currently SGX, we have 3 of them. Most of them are, in fact, all of them are investment grade, ranging between A to AAA rated. as well as there is a SGD money market ETF as well. So we are continuing to see combined net positive inflows in last quarter, bring the year-to-date inflows to 47 million. Beyond that, of course, we do offer Asia and China bond ETFs, which both have seen net redemptions in the third quarter. In terms of trading turnover, besides what I've shared earlier on, REITs and fixed income saw a higher trading turnover on the back of rising rates. Gold ETFs, we do have one that allow investors to invest directly into the gold market. That has dropped by about 45% in turnover on the back of a lower price volatility in Q3 23. However, month to date in October, we see that has reversed. In fact, there is higher trading turnover observed for gold, alongside with its rising prices on the back of geopolitical tension in Middle East. Of course, for equities ETF, it's still the highest traded ones. Last quarter, it ended about 2% drop quarter on quarter. But as a whole, we do see that investors' interest over the last 3 years continue to grow. In fact, it has increased 50% in terms of participation over the last 3 years. Largely, it's on the back of increased usage, or rather the ability to use ETFs as a building block for their portfolio. And one of the reasons, I think you mentioned REIT earlier on as a sector, there is increasing number of investors going to REIT ETF as well, because the beauty of an ETF really, in fact, lies on the ability to gain exposure into sectors and also multiple countries in a single trade.
I think that's a good last point right there. But you also mentioned, what's happening globally, right? With all the different, the context of the world today, and also the recent revelations of the political tensions, and also other factors at play here. So what should investors then look out for the final months, and how can they then utilize ETFs as a fundamental part of their portfolio, especially in Singapore?
Yep. So it really depends on individual investors, especially for more of the individuals investors who are trying to build their portfolio, be it for long term or in the short term, depending on their risk appetite, their tolerance, the underlying understanding of the underlying market in US and China in the region, and most importantly, their investment objective. ETFs can either be used by them strategically to increase their portfolio weightage to countries where they do foresee where they can gain higher growth over the next couple of months, in fact into 2024, or they can choose to use fixed income or REITs ETF to increase their weightage into certain asset class. I think as a whole, the whole idea is ETFs allow them to diversify their risk across multi-assets. If they are already, for instance, right, if an investor currently has an exposure or rather portfolio that's largely made out of cash and money market instruments such as money market funds or ETFs, they can choose to use ETFs, equities ETF, to gain exposure into foreign markets. And foreign markets could be as far as US underlying or even APAC underlying, and local markets such as ones that trade the Straits Times Index. And for investors who already have a large exposure into equities and wish to gain diversification in coming months, especially if they feel that equities market is going to a more volatile period, they can choose to diversify into REITs underlying, so that they can enjoy or rather ride through the volatile times.
Of course. I think that last point, I think just to round up our discussion here, I think some people are already interested about what's going on in the world, right, outside of Singapore, and how would that affect the performance of the ETFs. Perhaps we could summarize that.
Yeah, so as mentioned earlier on, right, for the more active ETF investors, especially those who are looking at today's climate, today's investment landscape, geopolitical tension, investors who are looking for a way to actively manage a portfolio in a way, because although ETFs is known as passive index tracking ETFs, for most of the passive index tracking ETFs, there is also active management techniques or the style they could put an overlay on their portfolio. So for investors today, I think ETFs, although it's a passive instrument, when they are using it, they could put in a more active approach so that they could react faster into the news that is changing daily.
Thank you so much, Wei Chin, for that. Now we'll be back with you shortly after I have more questions for Edward and Joel.
Yep.
See you soon.
See you, Olivia.
Let's invite Edward and Joel back onto the floor, please. Now, the first question I have, let's go into the fundamentals, okay? Going back to the topic of today, especially those who just joined us from the audience right there. Fundamentals, unpacking ETFs. What are exchange traded funds, ETFs, and what does it entail as an instrument? Joel.
Yes, sir. Thank you, Olivia. So if you can refer to our slide number 4, so ETF, they are essentially funds that are listed on exchange. So funds, they are investment vehicle that comprises a basket of assets. So with this, it gives investors the benefit of diversification. And being listed on exchange, the pricing will change throughout the trading hours, unlike funds, whereby you will be exposed to the closing day net asset value. So being quoted on exchange, right, the price that you receive or paid for will be subjected to the economics of demand and supply. If there's a huge demand for it, the ETF may be traded at a premium, or if there's no demand for it, it may be also be traded at a discount. So you also have the pricing transparency on exchange and the flexibility to place in your orders with this characteristic of being exchange traded. So moving on to slide number 5, you can see that an ETF is like a combination of a stock and a fund. So you can get the best of both worlds with this investment vehicle. So going on to slide 6, currently, right, all SGX listed ETF, they are passive ETF, meaning they have an investment objective of tracking its benchmark index. So what is a benchmark index? It can be referred to as your, for example, your Straits Times Index, your S&P 500, or even your China A50. So to achieve this objective, right, it will hold a portfolio of securities or derivative to track the index. And the term derivatives comes from the word derive, meaning that it derives its value from the performance of another asset or index. So a few ways for ETF to replicate the index. You can have a physical or direct replication, or you can go with the indirect or synthetic replication. So under direct replication, right, it can be a full replication ETF, meaning they will just follow the index wholesale. So to illustrate, if the index has 30 stocks, the ETF will just hold the same 30 stocks according to the index weighting. For sampling methodology, okay, the ETF may not replicate the index fully. A few reasons for this, because certain securities within the index may be very illiquid, or they are difficult for the fund manager to assess, like your India market, your Vietnam market. So for this method, right, it's more common for your bond ETF as well as your emerging markets ETF. So for synthetic replication, there are two main methods. One is swap-based. So for swap-based, right, the manager will enter into a OTC contract with a counterparty. So the counterparty will deliver the index performance for the ETF in exchange for returns based on the pool of collaterals that are held by the ETF. So this pool of collaterals will constitute the AUM of the ETF, and ETF unit holders are the end beneficiary of this pool of assets. So in Singapore, right, so swap-based ETF, there is a maximum of 10% net counterparty exposure. So in the event that the counterparty default, you can still get back 90% of your net asset value. So for futures-based or options-based ETF, it's very simple. The ETF will just buy into open market derivative to replicate your index performance. So a very good example of this would be your commodities index, because it doesn't make sense for the manager to buy into, say, barrels of oils or agricultural products to give you the desired performance.
Thank you so much, Joel, for that. Now, next question I have for you is, what then are the liquidity of ETFs and which tiers of markets are they traded on?
Okay, for liquidity or ETF, right, if you can refer to slide number 9, ETF, they are traded on the secondary market, as well as they can be created and redeemed on the primary market. So on the secondary market, there will be market makers who will be providing quotes for the investors. Whereas in the primary market, okay, you have PDs who can facilitate investors' creation and redemption orders. So if they do desire to bypass the exchange. So usually these are orders by institutional or high net worth clients. Yeah. So these are the two main participants that will be providing liquidity on the market. Then if you can refer to the next slide, which is slide number 10. So there are multiple layers of liquidity. So for retail investors like us, we often focus on the top layer, which is the first and the smallest layer of this pyramid. So one matrix that we often use to gauge this layer will be the average daily traded volume. So it represents the trading activities between different participants and shares that are traded. So in the event that, assuming that the market is very illiquid, there are no people trading the ETF, you will still have the market makers who will be providing quotes on exchange for your orders. So in the event that the market makers do not have sufficient units on hand to provide these quotes, right, they can go to the primary market with the PDs to buff up their inventory to provide the quotes on exchange. Then for investors like us, we also have the option to bypass the secondary market and go place orders with the PDs directly. And I believe that moomoo is also the PDs for our Green REIT ETF as well as the Chinex ETF. So to give a better illustration of this ecosystem, you can look at slide number 11. So for us, right, if you look at the right-hand side, okay, this primary market is invisible to us because we don't have access to data over here. So for us, the buyers and seller will be placing their trades on exchange. On the other hand, there will also be liquidity providers like your market makers who will be buying and selling ETF to the investors. So for slide number 12, okay, because ETF, they are traded on exchange, you will be subjected to the bid and ask spread. So you will be selling your orders at the bid price and buying your orders at the ask price. So the difference between this spread, this bid and ask price is referred to as the spread. So generally the NAV, the net asset value or the actual value of the ETF will be in between this spread. Why is this so? It's because the DMM, they want to buy from the market at a discount or to sell to the market at a premium to earn from this arbitrage. Okay, so any participants who will be coming in to make the market, right, that means they will place in the trade between this spread, will help to narrow this bid and ask spread. So there are a few factors affecting the bid and ask spread. So they are mainly divided into the fund factors as well as your external factors. So the fund factors, we are looking at the asset classes. Equities tend to be more liquid than your fixed income. So spread will be narrower. So if the asset is very volatile, like your small cap stocks or whatsoever, so because of this risk, the spread will tend to be wider. So another thing that we need to take note of is the time zone differences between your underlying assets and your listing country of your ETF. Any differences between these two will also affect the bid and ask spread. So for external factors, right, you'll be looking at the number of market makers for your ETF. The more market makers there are, the narrower the spread will be. And if the market makers, they have a high desired profit margin level, right, they may quote a wider spread. So other things you are looking at the exchange regulations. Is there any maximum limit that the exchange will allow the market makers to quote? And whether there are any things in the market like your hedging instruments to lower the risk for your market makers. And speaking of exchange requirements, if you can look at slide number 13, so there is a maximum of 2% spread between the bid and the ask price, which is imposed by SGX. So on each side of the bid and the bid quote and the ask quote, the market makers, they are required to place in at least 50,000 Sing dollars or the equivalent value, like say US $50,000 or 250,000 renminbi, depending on the currency of the ETF tickers. So additional requirements imposed on your market makers, right, is that they will need to provide this quotation for at least 85% of the trading hours for each calendar month. And for certain asset classes like your gold and money market, there can only be a maximum allowable spread of 30 basis points. So to illustrate the point again, right, on slide number 14, the pricing that you get on exchange is not equivalent to the true value of the ETF, because pricing on exchange, you are subjected to the economics of supply and demand and pricing actions by the market participants. So to get the true value of your ETF, right, you can take the total asset under management of your ETF divided by your number of ETF units outstanding. So you will get your true value of your ETF unit. But do take note that the price that you get on exchange is seldom the net asset value of your ETF. To get the net asset value, right, you have to place your trade via the primary market with your PDs. So moving on to slide number 15. So as you can see, right, for ETF price, if the net asset value is traded at the premium, you add in the premium spread is equivalent to the ETF price. Or if it's traded at a discount, you minus the discount spread is equivalent to your ETF price that you get on exchange. So what are the factors that will be affecting this premium and discount spread? Is also the same factors that is affecting the bid and ask spread, because they are somewhat correlated with each other. So the last point for this segment would be, if you do wish to trade ETF on slide number 16, right, you will need to take into account the trading cost and your holding cost for your ETF. So they will make up your total transaction cost. So for trading costs, right, it can be your round trip commission. So I believe for moomoo, the cost is quite low. In fact, it's very low. And then you also be subjected to the bid and ask spread, which is quoted by the market participants. So other trading costs that you will need to take note of will be your forex fees when you convert your Sing dollars into other currencies, any exchange fees or stamp duties imposed by the exchanges, market impact costs when you place in a large orders, you may be deviating from your preferred price. So for holding costs, beside the total expense ratio of your ETF, other holding costs that you will need to take note of will be your custody fees. Some brokers, they do charge custody fees as well as your dividend charges. So both of these charges, I believe, are not charged by moomoo. So for your dividend withholding tax, these are the tax jurisdiction between various countries, which you will have to pay for it. The dividend that you receive will be net off of these dividend charges. So all these little things and will meet up the total transaction cost for your ETF. Yes.
Excellent, Joel. Thank you for that. Now we covered what the fundamentals of ETFs are and what they entail as an instrument. We went through characteristics, and then we also went through the liquidity and also the different tiers of markets that they can be traded on. Now, before we go to the next question, here's the first surprise quiz for you. So those of you who are ready to actually answer this first quiz giveaway, type in yes below in the chat box. Type in yes. Okay, are you ready for the first quiz question? So listen carefully to the statement. ETFs can be traded on the secondary market exchange and redeemed on the primary market. True or false? If you think it's true, type in true. And if you think it's false, type in false very clearly in the chat box right now. So for those of you who just missed it, the question is, ETFs can be traded on the secondary market exchange and redeemed on the primary market. True or false? Type it in the chat box down below. You have 5 seconds. Okay, looks like we have our winners. Our teams will be in contact with you. Back to Joel. So more importantly, Joel, back to the topic. Now you've covered the basics, how then we can use such ETFs and also really apply this to our portfolios. And I think for the active investors or even just the new investors tuning in, how can they start to implement this in their current strategy?
So thanks, Olivia. So for ETF, right, one of the main benefits on slide number 18 is that they can be used for your portfolio construction. So because they are low cost and you have a wide variety of ETF available, so they are ideal building blocks for you to use them to construct your portfolio. So on slide number 18, I'll go through the different stages of portfolio construction with the viewers. So when it comes to portfolio construction, right, there are 4 stages. So every one of us here, we have different investment objective. Our income level is different. We're at different life stages. Therefore, our asset allocations will be different from one another. So based on your unique circumstances, you will then decide on your strategic asset allocation on your step number 2. So after you determining your strategic asset allocation, you can go down a level at step number 3, which is you can further customize your portfolio according to your needs with the use of sub-asset classes within your major asset classes like your equities, your fixed incomes, your cash. So moving on to the last stage, which is your rebalancing stage. You will go back to stage 1 and then you'll review your objective and constraint again to determine your asset allocation for your new objective and constraint. So I will further emphasize each of these stages in the next slide. So at slide number 19, right? So for our investment objective, is made up of 2 main components, okay, which is your risk and your return and risk targets. So there should be a reasonable expectations and achievable expectations for your return targets to reach your financial goals. So it must be a reasonable expectations. So example of financial goals can be you want to purchase a house, you want to pay your school fees, your vacation needs, your wedding expenses, and things like this. Okay. So for example, right, having a return target of 500%, it may be achievable, okay, but it's not a reasonable expectation without you undertaking significant risk to achieve this target and possibility of you incurring significant losses. So for every investments, right, it will comes with its own risk. While we cannot totally avoid it, can manage our risk based on how we allocate our assets. Even for your bank deposits, you're only insured up to say $75,000 by SDIC. So for risk, right, okay, it refers to the volatility of your assets and the total potential financial loss that you may suffer if things went wrong. So to estimate how much risk we can undertake, we need to assess our ability to take on risk and our risk appetite. So ability to take on risk is dependent on a few factors, things like your income level, your age group, your life stages. So risk appetite will refers to your willingness to bear risk. So one extreme spectrum will be like, so those gamblers who are willing to lose everything that they have. So your ability to bear risk should always be of utmost importance when determining your risk capacity. So yes, we also must not let our risk appetite affects our ability to reach our investment goals. So if you are too conservative, we may not achieve what we intend to achieve with our investments. So lastly, our risk capacity will affect our return targets. So having a low risk capacity and high return expectation, while ideal, right, is unlikely to materialize. So yeah. So high risk comes with high return and low risk comes with low returns, and you can manage this according to your asset allocations. So for your investment constraints on slide number 20, so one of the main things which will be affecting your constraints after determining your risk and return target will be your liquidity needs. So it refers to how much cash that we need to cover our daily and unexpected expenses. So your liquidity needs will affect how you determine your asset classes, which investment vehicle that you can buy, and of course, it also affects your risk profile. The next will be the time horizon for you to reach your intended financial goals. So usually having a longer time horizon will increase your ability to bear risk. Other constraints that we will need to consider will be legal and regulatory requirements, any taxations imposed on us, like a dividend withholding tax, as well as transaction costs. So all these little things will eat up into your total returns. So on slide number 21, I will talk more about the stage number 2, which is determining your strategic asset allocations. So there are 4 main asset classes. So the 2 over here are your equities and your fixed incomes. So for equities, right, they are not just an asset, okay? They represent an ownership of the company. So you do need to take note that when companies are in default, shareholders will be the last in line for claims on the company's asset, which also means that you will be subjected to the higher risk. So returns come in the form of a capital gain, your price return, as well as your dividend return. So and you need to take note that for dividend, right, companies, they are not obligated to distribute dividends or promise a certain level of payout. So but the benefits of equities is that they are readily available on your trading platforms. So for bonds, right, generally they are less volatile than equities, in the sense that you can get the repayment of your principal at maturity and your fixed payout at fixed interval in the forms of coupon. So there is also, you also place on the higher level of priority in the event that the company went to liquidations. However, right, for corporate bonds, minimum investment amount is about, I think, $250,000 per lot, which is not really accessible for the general retail investors, unlike your equities. So the next slide, on slide number 22, will be your alternatives and your cash equivalent. So alternative, they can be your commodities, your REITs, as mentioned by Wei Chin earlier on, and gold. Your properties could be your alternative investments. So because of alternative, they have low correlation with your traditional asset classes, right? They can offer diversification benefits for your portfolio. But however, certain alternative investments are only available to certain investors, things like your hedge funds, your private equities. So alternative, they may also require substantial investment capital and maintenance fees, like your properties, your physical gold are also subjected to high transaction costs and storage fees. So, okay, one of the main benefits of alternative beside diversification, right, you can use it to adjust your portfolio characteristics. So for example, in a low interest rate environment, right, investors often like to use REITs to increase the yield of their portfolio. And in a weakening, say, a dollar environment, a higher allocation is usually assigned to gold as a store of value. But in general, you need to take note that alternative investment may be illiquid, less transparent, and require a huge sum of investment amount. So the last main asset class will be your cash equivalent. So it refers to your cash holdings, your fixed deposits, your T-bills. So one good example will be your moomoo Smart Safe. So it can be referred as your cash equivalent. So okay, for cash equivalent, right, it provides a low return in a low rate environment. But in the current environment, right, it becomes a very, very attractive asset class, given its low risk. So for example, right, once your investment vehicle, like your fixed maturity matures, you can roll over your money over to a higher yielding say deposits, T-bills, or your government securities. So on slide number 23, right, I would say that there is no such thing as the best asset class. So different assets, they perform differently during different stages of the economic cycle, as you can see on the investment clock on the right-hand side. So the economic cycle is made up of 4 different stages: your recovery, your boom, slowdown, and recession. But over the long run, it should convert to a positive average, like the positive arrow, the uptrend arrow that you see. So a few reasons is because inflation often causes your asset values to rise. We have increasing global population, better technology for better productivities. Things like this will create value for the globally, which causes our assets to rise in value when we create value. So by diversifying across different asset classes, right, it ensures that your portfolio is weathered against the different stages of the economic cycle, whereby your outperforming assets will offset the losses made by your underperforming assets. And hopefully, over the long run, your diversified portfolio, it should deliver positive returns for you. Then on slide 24, you can look at the sample portfolio allocation, right? So of course, by allocating a higher weighting to more volatile assets, you'll be increasing the risk of your portfolio. But at the same time, you also enjoy a higher expected returns. So pending your risk and return profile, you can adjust and allocate your asset allocation accordingly. So on slide number 25, right, within each of these four main asset classes, right, you can have all these little sub-asset classes. So equities, you can go by different countries, different regions, sector or factor. So for bonds, you're looking at government bonds, your corporate bonds, investment grade bond, or your high yield bonds. Alternative can refer to your precious metals, your REITs, and then cash equivalent, if you prefer to go by T-bills or money market funds. Yeah, these are your different sub-asset classes. So, okay, why is ETF so suitable for portfolio construction is that one of the main reasons, right, besides being low cost for you to hold over a longer term period, is that you can easily find ETF with exposure to these little small sub-asset classes, and they are readily available on the trading platform for you to gain access to. And with this ETF, right, they will be the building blocks for your investment portfolio.
Mm-hmm. I think that's excellent, Joel. I mean, thank you for covering the stages of portfolio construction. You also covered, the different objectives and constraints within this, especially for those who are thinking of implementing this in their current strategy. And of course, the strategic asset allocation of this and how you can determine the factors around it. Now, before I go into the next question, here is the second surprise quiz for you. And for those of you who asked, the correct answer for the first one was definitely true. So definitely watch out for the teams to contact you because we will reach out to you after the live ends. Okay. Next surprise quiz question. If you're ready for it, type in yes clearly down below in the chat box. Are you ready? Second question, how many stages of portfolio construction are there? A, 3, B, 4, C, 6, or D, 9? How many stages of portfolio construction are there? A, 3, B, 4, C, 6, and D, 9. What is the correct answer? Type it in the chat box down below. You have 5 seconds. And in 5, 4, 3, 2, 1, we have our winners. Congrats to everyone. Now, Joel, what is the correct answer for this?
For the stages of a portfolio construction, right, there are 4 stages altogether.
Absolutely. So it was B for those of you who answered correctly. So next question, back to this, Joel. What does rebalancing mean and why should an investor pay attention to the rebalancing of such an instrument?
Yeah, good question, Olivia. So if you can refer to slide number 26, right? Okay. Our market is dynamic, meaning that it's constantly changing and your portfolio value will not remain stagnant or static. So as a result, your portfolio allocation, your original allocation will deviate from your target allocation. And because of this deviation, there will be misalignment between your investment objective and your portfolio risk and return profile. So a few ways that you can go about for rebalancing. So during rebalancing date, you can rebalance your portfolio back to its original target or to a new target allocation according to your new investment objective, because our life stages, our financial circumstances may change. Okay. So 2 ways which you can rebalance your portfolio. The first is that you can sell your overperforming asset and buy into your underperforming assets. The other way you can do it is that you can pour in new capital into your underlying asset classes to bring your portfolio back to its intended weighting. So these are the two ways which you can rebalance your portfolio. Then why we need to rebalance? Okay, so on slide number 27. So okay, for the first reason why we should rebalance is that rebalancing provides us with the opportunities to take profit from our outperforming asset classes and then allocate into the underperforming asset classes. It's a very systematic and rule-based approach for you to sell your assets and buy into undervalued asset classes. So in this process, right, you can eliminate any irrational or human biasness in your investment decisions. Then, because different asset classes perform differently during different market cycle, over the long run, your portfolio should revert to the mean. So your underperforming asset classes should perform, and your outperforming asset classes, there may be a drop in performance because of this reversion to mean tendency. So finally, right, rebalancing, right, offers us an opportunity to take a step back, review our investment objective again, and then realign our portfolio back to our investment goals. So the next questions that we often receive from investors is that when and how frequent we should rebalance. So if you can look at the slide number 28, there's a few ways. Okay, the first method is that a fixed interval schedule, whereby you can rebalance monthly, quarterly, semi-annually, or annually on a fixed date. So the other method is a threshold level. So you can rebalance whenever your asset classes crosses a certain level. So for example, if your equities exceed by 5%, you can reduce your exposure to equities by selling your equities and reallocating the proceeds back to other asset classes. The third method is that you can also use a combination of these two steps or these two methods. There is no right or wrong answer to this question on when and how often should you rebalance. But one thing that we all should take note is that the more often that we rebalance, the higher transaction costs we will incur for this process. So I think with this, I have finished my part on portfolio constructions. And I'll move on why you should use your SGX, why you should use SGX ETF for portfolio constructions. So a few benefits using SGX ETF for portfolio construction is that there is no minimum lot sizes. Okay, meaning that you're not trading in blocks of say 100 shares, 1,000 shares. You can buy as low as 1 shares, 11 shares, maybe 15 shares, up to your preference. So it's also very accessible to gain exposure to all the different asset classes that you wish to gain access to. Like Wei Chin mentioned in the first part of this webinar, there's a Vietnam equities, your emerging market equities, your China equities, China bonds, your REITs. Then another benefits over the SGX ETF have over overseas ETF is that there are different settlement options for SGX ETF. You can use your CPF funds for selected ETF. And for all SGX listed ETF, they are eligible for SRS settlement. Then you also have trading flexibility with ETF, whereby you can obtain live pricing on your trading platform and trade whenever the exchange is open. So with ETF, there are no sales charges. So generally, the total expense ratio for ETF is much lower than your funds. And with this, you enjoy the benefits of cost efficiency for your investment portfolio. Yes. So I've come to the end of my segment.
Thank you, Joel. So the next question then, how does UOB asset management actually come into this in terms of the ETF space, right? How are they involved in the ETF space? And then how can investors practically apply this from what they've gathered from Joel's part? Edward?
Yeah, so I think, today we are delving into the merits of investment opportunity through ETF with UOB Asset Management. So just a little bit of background about us. We are a distinguished asset manager in Asia with an AUM over $30 billion. I think UOB AM expands across 9 markets in Asia. We inclusive of 6 in the ASEAN region, which allow us to propel us to capitalize on our onshore Asian proficiency. Now, this in turn, affords our investor with unparalleled insights into the region investment sphere. Our diversified cadre of fund managers, analysts, and partners across major Asian markets like Singapore, China, Malaysia, and beyond definitely enriches our investment strategy, paving the way for a well-rounded investment journey, right? So now if you see in slide 33, these are the ETF that we have. Now, when you look into our ETF, it's basically, very much in the Asian narrative. Now, the economic crescendo of Asia is a narrative of global growth impetus. The thriving economies here are on a trajectory to become an even more influential on the global stage. So we should, explore how this region is blossoming into a substantial catalyst for, of course, worldwide economic expansion, focusing on the Asia Pacific region with real estate, as its linchpin, is at the forefront of the economic growth. Now, the surge in demand for sustainable building is not only a nod to, the eco-conscious practices, but also a precursor to increase rents and capital gains. So herein lies an investment prospect where APAC REITs emerge as a reliable source of steady and regular income. And with that, you can see here that we have our UOB APAC Green REIT ETF crafted to channel this sustainable income avenue. Next is, of course, harnessing the growth with China's innovative vigor, right? So China's economic resurgence is unveiling, burgeoning opportunities in key sectors such as healthcare, semiconductors, high-end manufacturing, and electric vehicle domain. These sectors are just not just innovation hubs, but also championed by China's top policymaker. So with the we have our tailored solutions, the UOB AM Ping An China X ETF, as well as the United SSC 50 China ETF, for your portals to basically partake in the China's innovative growth, right? So I think this is how we have been actually focusing in terms of our ETF. Is rather quite thematic as well. But I think we are riding on the Asia innovation, the mega trends wave. Yep.
Excellent introduction. And I think the key word here is the mega trend wave, right? Now, let's contextualize it a bit, the current trends. Now, just yesterday, I was on a run, and at MBS, Marina Bay Sands, there was a big drone show talking about net zero and sustainability, right? So I think that's something that's a real hot topic, especially in Singapore, trying to position itself within Asia Pacific and globally with the Singapore Green Plan 2030 and so on and so forth. So I think really, how can we look at all these trends within not just Singapore, but globally? And how can the investors then use this ETF to be involved in this space? Who are the major players as well? And what is the outlook for this, Edward?
Yeah, I think one thing that you have mentioned, one thing is that we firstly maybe I can touch on is that one of the mega trend is basically on the ESG, right? So
Yes.
I think, and when we look at an Asia Pacific or even Singapore, right, I think real estate is one big key investments in a lot of the investors out there. And today, nearly 40%, maybe I could refer to slide 35, nearly 40% of the world's carbon emission actually come from the real estate. And with the amount of building expected to double by 2060s, right? There's a big worry about even more emissions in the future, right? Now, these issues rings louder in Asia, where many cities face the threat of climate change. I think we are already experiencing it, like cities like Singapore, Jakarta, Hong Kong, and Tokyo are facing real climate threats like rising sea levels, severe storms, typhoon, and all, right? So this has put a lot of pressure on the real estate companies in Asia to cut down on their carbon emission quickly. Now, this push comes from the idea of double materiality. So what is double materiality? Basically is how environmental issues impact real estate activities and how these activities actually in turn affect the environment and people, right? And Asia is growing fast, and with growth comes a big demand for more building, right? That's natural process. But there's a catch. More buildings could mean more emission. Unless we make this building buildings greener, right? So the move, right, towards greener buildings is important. It's not just about meeting the growing demands of building in Asia, but also doing it in a way that is good for the planet, right? Because this is a planet that we all live in. We only have one right now, right? So greener buildings are definitely a win-win situation. They meet the demand for more space, help our environment clean, and balancing the growth of real estate with a caring environment is definitely crucial for a better future in Asia. Now, as we step towards an era of green real estate, right, we are looking at how growth and green practices definitely can go in hand. And when you look into slide 36, I think one thing previously I just mentioned that I have been mentioning green buildings, right? Green buildings, I think it's worthwhile to basically talk about what exactly a green building. So allow me to unreveal the green premiums. That basically a fancy term that you always see with green buildings is just that green buildings are basically valuable assets that comes with lower risk. So the question is, why go green? Basically, going green is actually good, easy as 1, 2, 3, as you can see the title of the slide as well. So one thing is that green buildings are not only friends with the environment, but they're also kind to tenants' wallet. What they do is they actually help cut down on operating costs by reducing utility bills, waste, and maintenance costs. And of course, imagine saving a good chunk of your electricity and water bills, right? And we all know that climate is changing, and with it comes challenges like rising energy costs and water shortage. And green buildings are like superheroes here, helping to manage these challenges with the efficient use of water, waste, and energy. And they stand strong against, of course, the likes of extreme temperatures and other climate woes. And now here's the cherry on top, right? Green building can boost your income too, right? They command higher rents, enjoy better occupancy rates, and even fetch higher sale prices. Now, this is not something that is made up by me, but it's actually a survey from JLL, Johnson LaSalle, even showed that, folks are leaning more towards green and sustainable spaces. Now, tenants are ready to pay a bit more to be in buildings that care for the planet. Now, it's a clear sign that going green is not just a trend, but a smart business move as well. So if you are a fan of REITs, now here's some good news. REITs that keep an eye on environment factors are in a better spot to tackle rising operational costs from energy and water. They manage energy use and emission wells, keep tenants happy, enjoy high occupancy rates. This means that, more savings, more income, and more profit. So who doesn't love the sound of it, right? Correct? So, and lastly, let's zoom out a bit, right? So green buildings are not just individual winners. They are players in the country's journeys towards reducing emissions. Just look at our home. Take Singapore's green plan, for example. It's all about sustainable developments and green building. So by supporting green real estate, we are all contributing towards a cleaner and greener future. So, investing in green building isn't just being about kind to the mother earth. It's a smart move for a promising financial future. As more people hop onto the green bandwagon as well, that we've been seeing in a lot of the part of the world, being part of this green journey could be a ticket to not just saving the planet, but also enjoying a hefty return on your investment. So I think, that's definitely a win-win, and we all want to be part of it, right? That is on the basically using what we call the green lens to look at it. But if we look into slide 37, if I switch the lens to the investment opportunity of, why APAC REITs, right? I think it presents itself a little bit more much appealing cases, right? So in a sense that within equities, REITs are, look upon favorably as an asset class. It allows one to diversify beyond the standard sector allocation. The risk profile also differs greatly given that they are an equity with bond-like features. And when we compare the Asia-Pacific REITs to the broader Asia-Pacific equity market, one thing is that it outperformed over the long term, right? Delivering an annualized return of nearly 8% compared to just 6% for the Asia-Pacific equities. And not only that, I think in the next slide, on the slide 38, when we look at the valuation yardstick, or what we call the price book ratio, is definitely supportive. You can see here that the red line is the performance, and even though we have corrected about 20% from the peak on the valuation front, however, which is the blue line, we are actually trading at a cheaper level, much lower at par value, and it means that the REITs are attractively undervalued at this current juncture. But of course, it comes with risk as well. Wei Chin has actually mentioned, the REIT sector has been impacted on the high interest rate, higher for longer regime that we are experiencing today as well. But I think one thing that I would also like to highlight in slide 39 is that, like what Joel has actually mentioned and earlier, building a portfolio. Now that is actually very important. And when we bring REITs into the mix of your portfolio, it is definitely going to be a smart move, because by inviting REITs into your portfolio, you're not just diversifying, you could also be enhancing your portfolio overall performance. It's like adding a pinch of salt to the dish, that little something to perk things up, and who doesn't like the sound of potentially better returns with a smooth ride along the way. And diversification with REITs isn't just smart, it's actually a proactive steps, towards making your portfolio robust and ready to face the up and downs of the investment world. So consider giving REITs a spot on your portfolio, and you might find your portfolio hitting notes that you never did before. And with REITs, you're not just investing, you're broadening your horizon in the investment realm. So if you can see on the chart itself, if you actually put in REITs into a different portfolio mix, there is a much better improved risk-adjusted return. Now, some of the things in slide 40 is that, I just want to kind of summarize that in terms of the case of APAC REITs, I think one thing is that REITs definitely give you the stable incomes and returns, right? And being APAC REITs, it actually allows you to have access to diversified property assets in various countries. Some of it are actually exposure to, alternative or niche assets, the likes of your multifamily, retirement homes, so on and so forth. And we still do see a strong dividend growth continues. I think roughly in the APAC is about 4.5% CAGR. And I think there is attractive valuation. Right now is actually below the price book basis. And I think one thing is also the performance of REITs, of course, right now, what we are experiencing is because of the higher for longer regime, where interest rates will likely to stay for the longer term. And when we look at slide 41, I think basically what we did was that we, together with SGX, with SGX IH, we actually came up with the first APAC Green REITs index as well, where it's a collaborative effort together with them. What we plan to do is, of course, we want to actually contribute to the green of the real estate sector with a focus on Asia Pacific. We are strong in Asia as an asset manager, and also we want it to be yield focused by choosing green REITs with higher dividend yields, and of course, selecting real estate companies with positive green impact as well. And lastly, I think, this is actually the index methodology. I wouldn't actually dwell too much on that, because it will take up a lot of time, but I want to say that the index is actually rebalanced on a semi-annual basis in March and September. And now the starting universe would be, over 200, nearly 300 APAC REITs. Then, what happened is that, like most index construction process, the REITs will be filtered for eligibility to pass the threshold of liquidity, free float market. And also we want to actually avoid REITs that have poor dividend, or what we call the dividend yield trap, which we will exclude REITs which have announced very promising dividend payout, while performance actually fall laggard comparing to peers. But I think one thing that I want to actually focus is, we want to focus on the last finalized 15 names. So the initial weight will be allocated according to their free float market, and then we actually add this thing called green tilting. That's when the green tilting come in. That means to say we actually reward constituents or REITs with greener credential by applying a green tilting factor. Now, the green tilting factor is basically decided by a REITs environment overall score by GRESB itself. So we use GRESB, who is actually the data provider for how green these REITs are, and basically a lot of REITs out there actually report their a sustainable report to GRESB, where GRESB will actually analyze how green they are. And I've mentioned earlier, right, a lot of tenants are looking for much greener buildings, and there is a benefit for these REITs to actually report their sustainable agendas to Gretzky as well. And of course, in the next slide, that's how we actually came up with the ETF to basically track the IHUOB APAC Yield Focus Green REIT Index, which is on the slide 43. And the index is basically comprised of a basket of 50 REITs, which deliver high dividend yield to investors by investing in Asia Pacific, including Japan, and of course, focusing on green REITs, which are identified by a high ESG quality. And of course, I've mentioned earlier, the index does go through rebalancing, and slide 44. This is the latest rebalance that we have in September 2023 in slide 44. And of course, in slide 45, these are the sectors and country allocations. So the countries are basically Japan, in terms of the country allocation, Australia, Singapore, and Hong Kong, and some of the sector allocation that you've seen. And of course, in slide 46, you have the top 10 constituent. I wouldn't delve too much into it, but I think this is the whole nature of the APAC Green REITs ETF that we have. So a little bit long on the answer, but Olivia, that is my answer to you, and I hope I cover most of it. Yeah.
Very strong, and also great arguments there, especially for those who are already asking questions from the audience. So you've definitely answered some of their questions, especially about the index rebalancing update and also the unique characteristics of the ETF. Now, before the last question and before we go into the live Q&A, here is your next question for giveaway. Okay, so those of you who are ready, you know the drill. Type in yes below if you're ready for this quiz giveaway. The question is, now listen carefully, you've got to name the 4 countries that are part of the UOB APAC Green REIT ETF. Name the 4 countries that are part of the UOB APAC Green REIT ETF. You have to list the 4 correct countries, okay? All right, you have 5 seconds left. Okay, so what are the 4 countries, Edward? So the 4 countries are Japan, Australia, Singapore, and Hong Kong. Now, the last question before we head into the live Q&A, I would like to pivot our attention towards China, okay? So before that, I think we'll come back to the China component. I think Edward just accidentally dropped off the call, but it's okay. Let's go into our live demo before we get Edward back on the call, okay? Now, great insights there. Now, if you have your moomoo app with you, come and follow through with me. Okay, so take out your moomoo app with you, and I'm going to show you how you can access this particular promotion, okay? So open your app. You can see the screen just like this. It's very straightforward. Now, this is very important for people who want to apply what they learned from today. Now, go to your profile. You click on promotions. Click on the first component right here. Okay. So you've got right here, you can see the current promotion, but of course, if you do want to go into a deeper analysis for yourselves on what was discussed today, you can use this as an example, okay? So you can just click on the particular ones and you can see the details and the profiling for each particular ETF. Now, there are 3 listed right here for your choosing, but of course, let's, for example, for the purpose of today, let's go into the APAC Green REIT ETF. And you can see over here, all the news and the details that you can get from that, okay? So definitely check it out for the overview and also the summary, the news analysis related to this. And of course, you can adjust and customize accordingly to the time frame and the time horizon that you're looking at for your investments. And also you can also add it into your list of tracking right here. Just click on the heart on the top right-hand corner and you can see more details right here, okay? Now, I know some of you may have joined halfway for this live, very, very easy to watch the replay of this. You just go to Discover, click on Moo, and you can see over here, I've got my whole community right here, but you go to the live tab and you can see we're live right here, right now. Okay, so right here is where you can find the replay when it's concluded. But of course, definitely check out all the webinars and events that we have ongoing for you. And definitely always curating and crafting new content for you. So check it out and save it on your list. Okay. Now, do we have Edward back on the show? Hi, Edward.
Yes.
Now, Edward, going back to our final part of the discussion, because I do want to take some questions that we have from the audience, a lot of questions coming in.
Right.
So the last question is really about going, towards the attention of China, for example, right? I want to pivot our attention towards that and the update on that. So how is the Chinese onshore and offshore performance before we close off 2023? And what can we look forward to in 2024, Edward?
Okay, great. So I think that's definitely a good question. Chinese news has been on the media almost on a daily basis. We're seeing a lot of news out there. But I think one thing is that we definitely will want to actually touch and highlight a bit on the Chinese opportunity to kind of things. Of course, there's a lot of noises in the market right now. So if you don't mind, when we look at the market capitalization of China onshore versus offshore, if you look at it, it's on slide 48. I think one thing is that, when we look at in 2018 June, right, A-shares was actually included in the number of mainstream like MSCI indices for the first time, including MSCI China, MSCI Asia ex-Japan, Emerging Market Index. But the MSCI has kept the inclusion factors of A-shares at 20%, which means only 20% of the market capitalization is actually recognized. And as it stands, A-shares are still, severely underrepresented in the global indices. Now, why I'm saying underrepresented is if we look at the GDP of China, it's basically just behind of US. So, in fact, if we were to look for, factor to factor, I think in the MSCI, probably, you should have probably the same kind of weightage in terms of the market cap, right? And when we look at it, when you look at China onshore versus offshore, what we're seeing is the Asian market is actually a huge market. That means to say we have a lot of opportunity inside there. When we look at it, the number is about 11 trillions in terms of market cap. And then when we look at the, when we were always familiar with the H-share market, the H-share market is basically much smaller. And if you look at into the China ADRs, which, the Chinese companies, they're listed on the American exchanges, relatively it's the same as the H-shares, but even when they add up, it's probably just going to be a little bit more than half than just the A-shares. So that means to say the market cap of A-shares onshore is huge, and we have a lot of opportunities inside there. And when you ask about performance, I think I'll be very happy to actually share on slide 49 is that of course given whichever Chinese market we're talking about, onshore, offshore, they have been impact significantly, right? So if you see in slide 49, but what I want to show you is that when we look at onshore versus offshore, I think offshores are hit hardly, right? Offshores are hit hardly. Onshores are also hit as well, but there are some resiliency to it. And basically,
Okay, so I believe that Edward has accidentally dropped off the call again, but it's okay. I think he was just summing up the onshore and offshore performance before we close off 2023. I hope you got those final points right there. If you do want to watch the replay of that, you can after the live, but we'll close off later on. Okay, let's go into the live Q&A. So let us invite everybody back into the room, please. So of course we have Wei Chin and Joelle on the line with us. So I've got a lot of questions here. The first question is about Singapore market. So I'm a new investor starting off with the Singapore and market, what do you suggest for ETFs within this space, in terms of where I should be looking for the instrument, and also what type of ETF is better suited for investors looking to invest in a long-term time horizon? Wei Chin?
Hi, Olivia. Thanks for having me back. Yeah, so I got a question. So probably start off with the question surrounding how to start off in the Singapore local market. Assuming the investors has probably investments or rather capital in SGD. If he's looking to enter into or rather build a core portfolio surrounding SGD denominated investments, a few options lies within the equities ETF space to include the Singapore focused ETFs. I think most investors in Singapore are familiar with the Straits Times Index, which tracks the 30 largest blue chip companies. Obviously, there are also a few other thematics products that focus on low carbon and also dividend focus Singapore companies ETFs. So I see that the Q3 report has been shared on the chat group. So probably investors can look out for the range of ETFs there. And for investors who are looking to deploy their S3D investment beyond Singapore companies, there are also other Sing dollars denominated ETFs that are available and offer investment opportunities into beyond Singapore markets. A very good example would be the Hang Seng Tech ETF listed on SGX. That's one of the top traded one. It does has a SGD counter as well. So not too afraid of FX conversion, or rather not to be bothered by the complexity of FX conversion. Investors can easily buy into Sing dollar counters for overseas investment on SGX. And last but not least, for investors who do not want to go into 100% equities, because certainly the volatility of equities tends to be higher than the other asset classes. One good option would be to also add in the fixed income REITs or even gold ETF to the mix. And the good news is obviously most of them do have a Sing dollar denominated counters for investors to trade in.
Thanks for that. Now, the next question, they're wondering what they should select for their overall strategy, for example, in terms of maybe starting out of percentages of overall portfolio versus funds or stocks. So this is really about allocation. And also maybe you could highlight some of the potential risks and ways to mitigate this risk, particularly for Singapore, but also on a global scale. Maybe we can start with Wei Chin first.
Sure. So in terms of asset allocation, this really lies on the ability and tolerance of investors to take risks. Also depending on their investment cycle, where are they? Are they looking to build a retirement funds, or are they close to retirement looking for capital preservation? So like all other investments, you should look out or rather hear from investment advisor, professionals, to understand how you should deploy your capital. But beyond that, if you're looking for, let's say, 60-40 traditional asset allocation, which is probably an approach that many investors may take for more balanced ones, 60% equities, 40% fixed income. The good news is, and I do see a question asking about unit shares. The good news is that SGX do allow unit shares trading for all ETFs listed. And with that, investors can easily customize a 60-40% allocation. And what goes into the 60% equities, it really depends on their preference. A lot of investors may, we do see a lot of investors holding onto STI ETF as a core allocation, which probably could be because of their familiarity with the local companies. But nonetheless, we do also see other ETFs such as those with China underlying and also US underlying gaining popularity. So what's the weightage across individual countries? Really, that depends on individuals' view in these countries' economic development and what the expected returns they expect over the investment cycle.
Thanks for that. Now, I have an extender question, but I think maybe Joelle, you could give us some perspective on this. There are many ETFs out there, and Wei Chin definitely summed it up for us. But how do we avoid the fund overlap to mitigate the risks?
Okay, for these questions, right, because ETF, they are transparent investment vehicles. So to prevent overlapping of your investment, do visit the ETF manager's website to look at the holdings list. So with the holding list, you are able to compare the differences or similarities between the different ETF to ensure that you do not have any overlaps within your portfolio.
Thanks for that. Now, anything to add on? Because the next question is really about the differences between similar mutual funds and ETFs, and also their potential investment opportunities. Who would like to take this?
Okay, maybe I go with that. And
Of course.
apologies on the technical issues we're
No
having
problem.
at
It happens.
UOB. Yeah, so having tech has its own downside as well. So okay, maybe just come back to the question is that, there are definitely some overlaps in some of the ETF in terms of asset class and probably also on the fixing, also on the mutual funds. I think one aspect is that, of course, ETF has its own benefit, mutual fund has this as well, but some things that I would like to highlight is that in the differences of, especially on the fixed income ETFs, I think one thing is the fixed income universe is really big, right? One thing is that on mutual fund itself, on the active managers, I think, having the selection of good underlying credits or fixed incomes or bonds is actually also a key. So in that sense, in terms of this this asset class itself, some of the mutual funds or even all these unit trusts probably will have a better value proposition, right? But in terms of ETF, probably some of the ETF fixed income that we see is probably tracking the treasuries and so on and so forth based on the different duration. But that's the choices that you probably have. So to me, is that there is definitely will have some overlap, but in the end of the day, when you are actually, looking into investment, like what Joel have actually mentioned earlier, building a portfolio is very important, right? So, you have your ETFs to basically go into some of the subsectors to give yourself some exposures, low cost. But in terms of some things like in terms of moving into fixed income asset class, probably some of the mutual funds out there does a better job than the ETF. And of course, credit selection is also key in the fixed income asset class, and that could actually help you as well. So I think one thing is you really need to understand, what kind of asset allocation you're going to go for, what kind of risk that, you are going to take as well. But nonetheless, I think all investments have their own pros and cons, and like what Joel said, there isn't the best asset class. Every asset class has its own ups and downs. Yeah.
Mm-hmm. Great. Next question. Are index tracking ETFs or actively managed ETFs better? Perhaps I'll rephrase that slightly. What are the pros and cons for each and what can they consider? Wei Chen.
Yep. So I'll take this one. I think Edward has mentioned the active funds as well, mutual funds earlier on. So I think just for investors to understand, the key differences lies between mutual funds and ETFs, be it passive or active, is that one would be only available via distributors. And investors can only place in orders to the distributors, and they would know what's the price they're getting end of day when the orders are being fulfilled by the distributors to them. ETFs, however, allow investors the intraday liquidity on the exchange, i.e., they would know right on the spot the fund prices they are entering at. They're able to buy or sell throughout the day. They are able to faster react to the market news when it happens and able to liquidate or add on to their positions using ETFs. And if you are talking about performance-wise, obviously one passive ETF is looking to track an index, so the performance is largely dependent on the movement of the index itself. So for example, if STI ETF, if STI moves by say 10% a year, you're likely to see the underlying ETFs also move by close to 10%, less of any fund expenses and also tracking error. Whereas an active ETF is likely to aim, assuming the benchmark is STI, they would likely to aim to beat that 10%. And whether that can be achieved or not, I think that really depends on the ability of fund managers, their management skills and styles. And also, I think the best way to gauge is looking at their past historical performance, although have to say that doesn't reflect the future performance of the fund.
Mm-hmm. Thanks for that. Now I have a product related question here. Is there a monthly, quarterly dividend payout for this? Joel?
Okay, for ETF, right, fund managers, they do have the flexibility to determine the frequency of the dividend payout of the funds or the ETF. So it can be monthly, quarterly, semi-annually, or once a year. So for this information, right, you can refer them to the ETF website by the fund manager. So they do provide it. So depending on your needs or your requirements, you can select the suitable ETF with the desired dividend frequency that you're seeking.
Mm. Thanks for that. Next question, and I'm going to take this as the final question. Thank you so much, everyone, for being so engaging today. What are your views on options-related ETFs? It seems to have quite an attractive yield and pays a monthly dividend. So what are the risks I need to take note of before buying into those ETFs? Who would like to take this? Edward, let's start with you.
Sure. Okay, I think yes, there's a lot of kind of ETF out there. You have the options related, you have the
Mm,
leverage, you have the short kind of ETF, you have a synthetic ETF. But one thing that I will want to basically highlight, and I always tell investors out there, is you got to understand what are the underlying, right? You got to understand how options work. You got to understand how leverage works. And if these things are not familiar to you, and you don't understand the mechanics of it, even though no matter how attractive the yields are, it might not work for you if the markets turn south, right? For example, and of course, at that point of time, you'll be struggling to understand why it seems so attractive, but now it is going against me, right? So I think one thing is go with something that you're familiar with, go with something that you are comfortable with in terms of your risk level. Not everything that shows you high yields means it's a good product. Not everything that shows you, double rate returns means that there is something that you should go for. I think what most important is you understand what are your long-term goals, how do you want to actually achieve it, what kind of instruments you want to use to achieve those goals, how do you want to diversify your portfolio, and basically derivatives itself of course, the nature of itself is that, of course, it can give you good returns, so on and so forth, but it can also work against you. So at the end of the day, your risk and return, kind of adjusted portfolio is very important for you. So I think that is my word of caution itself. You basically
mm.
understand the underlying, understand the product itself. That is key. Yes.
Excellent. Very important point there. Now, Wei Chin, just to wrap up our live Q&A, do you have any insights to share from the SGX group for these, options related ETFs or all the other variations of it that Edward covered?
Yep. So I think Albert made a good point. There are many innovations in the ETF space, precisely because of the popularity you have gained by investors over the
Mm-hmm.
years. Globally, is a probably over $10 trillion market today. So be it options underlying or non-options underlying, the main objective is really for investors to express a view in the market, and a mixture of options along with the traditional underlying securities is to generate a kind of returns performance, or rather performance return that investors wish to achieve. And one thing that they really have to understand is what's the underlying in the funds, right? Because you should only buy into investments that you understand,
Mm-hmm.
be it option underlying or non-option underlying. If the investors do already have a view from within themselves, um, that's the criteria before they choose any investment products, right? An ETF is simply a tool to use to express an investment objective, and that should work that way rather than looking at the product then decide whether you're buying. You should really look at what's your investment objective you have in life at the current stage before
Mm.
choosing the investment, the ETF tool that you want to utilize.
Excellent point right there. Now, thank you to the audience for your questions. Now, gentlemen, what is the last takeaway before we wrap up so that they can really have that final point to take home so that they can invest smarter? Joel.
Yes, I would like to emphasize the point that each of us here, we are different with different investment objective, needs, and requirements. So with ETF, you're able to gain exposure to all the different sub-asset classes at a very, very low cost. Then together with moomoo, you also enjoy a low trading fees and I think even no holding costs. So do give ETF a try, and hopefully over the long term, you'll be able to enjoy your positive returns with your portfolio.
Wei Chin, what about yourself?
Yeah, I think first of all, thanks Momo and Olivia for hosting us today. And I think it's a very exciting journey we're having with the clients from Momo. And just to second what Joel has shared, ETFs is a low-cost, transparent, liquid products that allow investors to express their views. So just be continue to learn as you go, and always the call I gave to investor is always understand what you're buying into before entering a trade.
Great point there. Now, Edward, let's end off with you.
Yeah, so firstly, apologize again for the technical issues, but I think my closing statement will be that, UOB Asset Management, we are inviting you definitely on a rewarding investment odyssey across Asia with our suite of ETF solutions. We, encourage you to explore the diverse economic landscapes, tap into the sustainable income streams, and of course, seize the growth opportunities that lie within this vibrant region. And your journey towards a prosperous investment futures begins here with both UOBAM and definitely moomoo at your side. So I think that's how I actually end it off.
And that was SGX Group's Wei Chin, as well as Edward and Joel from UOB Asset Management, everyone. See you for our next show together, gentlemen. Now, to the audience, if you have any more questions, remember the chat is always open for you to drop them in there. But of course, you can also email the teams. But more importantly, if you do want to stay on top of all these live streams and also educational content just for you, of course, we always have shows with experts like today. So really follow us, scan the QR code right here. We've got 2 QR codes left and right. On the left, it's in-app. So I definitely update as soon as we get a new show up and running. And on the right-hand side is where you can get all the information of all our social channels to follow. So definitely check it out right now. And of course, I covered this during the short demo, but you can also check out the promotion that they have for ETFs right now. Scan the QR code right here if you do want to get direct access to what is available right now. There is a time limit, all right? So definitely check it out as soon as you can. As always, it was a pleasure having everyone with us. We'll see you for our next show. Happy midweek, everyone, and enjoy the rest of your evening. Once again, you're with me, Olivia Higgins, and happy investing.